$4,525 per ounce, $72.70. Two figures that shouldn't exist together in such an explosive way, yet here they are, lighting up screens, dominating headline tickers, and sending a shiver through markets from New York to Mumbai to Shanghai. Gold and silver, metals mankind has used as money, measure, and myth for millennia, are now roaring higher at a pace that has stunned investors around the world. Gold, climbing above $4,500 per ounce for the first time ever, has rocketed more than 70% this year, its strongest annual performance since 1979. Silver, once overshadowed by its lustrous cousin, has shattered expectations, with gains that eclipse gold's by wide margins, exploding past $72 per ounce in what many are calling one of the most dramatic rallies in commodity history. This is not quiet growth. This is not a gentle uptick that analysts bury in footnotes. This is noise. This is speed. This is capital in motion, and markets are trying to interpret what it means. As day turns to night across global exchanges, the question reverberates through trading rooms, dinner tables, and investment forums alike. Why now? What combination of forces, economic, political, psychological, structural, have driven both gold and silver to such rare heights simultaneously? And does this explosion signal something deeper, a hidden rift beneath the surface of the U.S. economy, a silent drumbeat of stress that traditional data isn't capturing? Imagine markets as a great stage where every actor, from Main Street to Wall Street, watches, reacts, and anticipates. Some watch jobs reports, some watch inflation prints, others watch policy decisions and geopolitical signals. But right now, almost no one is taking their eyes off the precious metals. Because gold at $4,525 and silver near $72 aren't just numbers, they are messages. Messages that weave fear, anticipation, expectation, and uncertainty into every tick of the price chart. Turn your eyes to the visual, an animated chart with gold's path since the start of 2025, beginning near $2,600 per ounce and climbing relentlessly to $4,125. Beside it, silver's curve, steeper still, rises from around $28-30 at the start of the year to above $72, a trajectory that looks almost vertical in parts. Beneath both lines, volume bars flash, glowing brighter as institutional and retail flows surge in lockstep. Traders speak in hushed tones about COMEX volume spikes and ETF inflows that defy seasonal norms, creating price moves that feel as emotional as they are economic. At face value, this rally defies simple explanation. The U.S. economy, on the surface, displays resilience. Recent data showed gross domestic product growing at an annualized 4.3% in the third quarter of 2025, stronger than many forecasts had predicted. Major stock indices, including the S&P 500, have flirted with record highs fueled by robust earnings in select sectors and ongoing enthusiasm in AI and tech. Yet beneath those high-level snapshots lies a tangled web of contradictory signals. Consumer confidence indexes have slid to multi-month lows, with households expressing heightened anxiety about prices, jobs, and financial security. Labor market improvements, while persistent, appear uneven across sectors. And inflation, though not exploding, has remained more stubborn than many expected. The macro picture is messy, fragmented, and emotionally charged. So how do we reconcile strong headline growth with an investor base that seems to be pricing in fear? How do we explain a rally in safe haven assets happening at the same time as equity markets show resilience? The answer is not singular, not linear, and not obvious. It is a mosaic, a mix of capital flows, psychology, policy signals, structural demand, and global uncertainty that all land squarely on gold and silver. To understand this moment, we have to examine how money moves when it is unsettled. In any financial system, capital flows toward perceived security and opportunity at the same time. Traditionally, gold has been viewed as the ultimate refuge, the asset that shrugs off currency devaluation, political instability, and inflation fears. Silver, while also a safe haven, wears two hats. It is both a precious metal and an industrial powerhouse. Its demand is tethered to technology, from solar panels and electric vehicles to advanced electronics, and its supply dynamics are far more constrained than most realize. In 2025, industrial demand has surged and supplies haven't kept up, creating structural tightness that adds fuel to the price fire. Look at the flows. Central banks, long conservative in their reserve strategies, have been significant buyers of gold in 2025, diversifying away from a heavy reliance on traditional reserve currencies. Sovereign wealth funds from Asia and the Middle East have upped their allocations, not for short-term profit, but for long-term hedging against geopolitical risk and currency volatility. At the same time, exchange-traded funds backed by gold and silver have seen massive inflows that outpace anything witnessed in the past decade, drawing both institutional and retail money into positions that look less like speculation and more like insurance policies against an uncertain future. Retail investors, Ordinary individuals trading through platforms and ETFs often behave differently from professional allocators. When retail demand spikes, it is usually tied to sentiment, not pure fundamentals. Momentum traders see parabolic charts and chase positions, amplifying moves that would otherwise remain measured. Silver's rally, in particular, has been characterized by this dual impulse: industrial demand plus speculative fervor. What might have been a gradual upward trend fueled by real sector growth has become an almost viral price movement because the market's psychology has shifted into high gear. And why has that psychology shifted? Part of the answer lies in the monetary backdrop. Throughout 2025, the Federal Reserve has kept markets on edge with ambiguous signals about interest rate direction. Early in the year, expectations of rate cuts were widely priced in for the end of 2025 and into 2026, as inflation appeared to moderate and labor market data softened in key areas. Rate cuts reduce the opportunity cost of holding non-yielding assets like gold and silver. They don't pay interest, making them more attractive in relative terms when yields on safe assets fall. Investors don't just react to rate decisions, they anticipate them. Futures markets began pricing in multiple cuts well before any official moves. And that anticipatory behavior became a self-reinforcing driver for metals as capital rotated out of cash and low-yield bonds into tangible assets. Yet a twist arises. If markets were pricing only a straightforward recession, then all risk assets would be collapsing. Stocks, credit, consumer finance, in harmony with safe havens. But that is not what we're seeing. Instead, equities have shown resilience in pockets, technology stocks have rallied, and corporate earnings remain healthy in many sectors. That contradiction tells us that the market is not pricing a single future, but a range of possible futures, some involving slowed growth, others involving persistent inflation or geopolitical shock, and still others involving policy missteps. Gold and silver become the common denominators in all those scenarios because they act as stores of value when the future is uncertain in any direction. Now, layer in policy dynamics, particularly around trade and geopolitics. In Washington, rhetoric around tariffs and trade tensions has been a recurring theme. President Donald Trump's posture on tariffs, trade barriers, and protectionist measures has added another layer of uncertainty to global commerce. Even absent clear economic impact, the expectation of volatility, the narrative of risk, seeps into investor psychology. Tariffs affect cost structures, earnings forecasts, and cross-border trade flows, introducing complexity into corporate planning and international supply chains. Markets hate uncertainty. They do not wait for numbers to prove what they fear might happen. They price those fears in advance. The interaction between policy rhetoric and monetary policy is particularly potent here. Trump-era signals about fiscal stance and pressure on the Federal Reserve to adopt looser monetary policy, to cut rates preemptively or maintain accommodative conditions, have fed into expectations of rate cuts in 2026. Those expectations have reinforced the case for metals. Investors who once might have held yield-bearing assets now find themselves facing a landscape where yields may drop, the dollar may weaken, and geopolitical risk may rise. The safe haven appeal of gold and silver becomes stronger as the opportunity cost of holding them falls. But it is not just monetary policy and rhetoric. There are real structural dynamics at play. Silver's industrial demand cannot be ignored. Unlike gold, whose price primarily reflects perception and store of value utility, silver has a foot in the physical economy. Tea is a critical component in solar panels, electric vehicles, telecommunications infrastructure, and advanced electronics, sectors that are expanding rapidly. Global demand for silver from these industries has outpaced supply for several years, creating a market deficit that shows little sign of abating. In fact, inventories in major trading hubs are at multi-year lows, and supply deficits are expected to persist into 2026. This structural squeeze adds a force multiplier to silver's price moves and explains why silver's gains have outpaced gold's so dramatically. This interplay, industrial demand and safe haven demand, is rare. Usually, a rally in gold and silver reflects one dominant factor: fear during crises or optimism during growth surges. But in 2025, markets are pricing both: fear of uncertainty and anticipation of industrial growth. That makes this rally fundamentally different from many in recent memory. It is not just a flight to safety, it is a flight to adaptability, capital positioning for multiple potential outcomes at once. Bond markets reflect this complexity as well. Long-term Treasury yields have fluctuated wildly. At times, yields have collapsed to levels that historically signal recession expectations, as investors rush to lock in future returns and flee credit risk. At other moments, yields have spiked, signaling inflation concerns or shifts in global demand for U.S. debt. The yield curve itself has twisted and kinked in ways that defy simple interpretation. In this environment, gold and silver become hedges, not just against one macro state, but against a spectrum of macro states: recession, inflation, stagnation, and geopolitical shock. Currency markets add another layer. The US dollar, historically the anchor of global finance, has weakened against major currency baskets at various points in 2025. A weaker dollar makes dollar-priced commodities like gold and silver more attractive to foreign buyers, increasing demand from outside the US and amplifying price moves. Currency shifts often reflect deeper confidence signals, trust in monetary policy, trade balances, capital flows, and when those signals become murky, metals often absorb the ambiguity in their prices. To understand the psychological force behind the metals rally, picture this: a market that no longer trusts singular narratives, where one group of investors sees inflation risk, another sees recession risk, where one portfolio hedges real assets, another chases momentum and chart breakouts, where one central bank buys gold as reserve diversification, another fund bids up silver based on industrial scarcity. In this moment, gold and silver become the common language for a multitude of fears, hopes, and contingencies. This is why the dual rally is so puzzling and so powerful. It is not reflecting one story. It is reflecting many stories at once. It is telling us that markets no longer see a single future for the US economy or the global system. They see a range of possibilities, and in the absence of clarity, capital is hedging broadly. Gold and silver are the instruments of that hedge. Now consider the broader commodity complex. Copper, often called Dr. Copper for its ability to signal economic health, has also hit record highs above $12,000 per ton, driven by industrial demand and supply constraints exacerbated by trade policies and tariff expectations. These moves in multiple metals suggest that markets are not only hedging, but rebalancing towards real assets. Assets that have intrinsic physical demand or long-term store value characteristics. This broad metals rally is reflective of capital reassessing risk, value, and future trajectories across asset classes, not just within the precious metal space. Yet despite these powerful dynamics, it would be simplistic to say that gold and silver's ascent proves recession is imminent. If markets were pricing only recession, then you would expect a synchronized collapse across all risk assets, stocks, credit, consumer finance, in lockstep. But that is not happening. U.S. economic growth, even if uneven and contested beneath the surface, has not collapsed. Sectors like technology and consumer discretionary still show pockets of strength. Corporate earnings, while variable, have not broadly imploded. This tells us that markets are not pricing one future. They are pricing a cloud of potential futures, some dark, some hopeful, and many ambiguous. What's unfolding feels less like a monologue and more like a chorus of probabilities. Recession risk, yes. Inflation risk, yes. Policy uncertainty, yes. Geopolitical stress, yes. Industrial expansion, yes. Gold and silver are the common denominators across these scenarios. Not just hedges against fear, but hedges against uncertainty itself. And that brings us back to the real question. What does it mean for the U.S. economy that gold and silver are exploding together? Does it mean a recession is coming? Maybe. Does it mean inflation is entrenched? Possibly. Does it mean markets have lost confidence in traditional indicators? In part. Does it mean investors are positioning for a world where uncertainty is the default state? Almost certainly. In this moment, markets are telling us something deeper than any single economic report. They are whispering, and sometimes shouting, that the future is not known and that capital will adapt faster than data can report. And so the final question, the one that reverberates through every trading screen and dinner table conversation about economics, is this. If gold and silver, two metals with different traditional roles, are exploding together, one rooted in refuge, the other in both refuge and future demand, what does that say about the confidence we think we have in the U.S. economy and the confidence that actually lies beneath the surface? And if markets are pricing many potential futures at once, which one are we truly preparing for? If you want to stay ahead of these market shifts, understand the forces driving gold and silver, and navigate uncertainty with insight, subscribe now and join our community of informed investors. Don't miss out. Hit the button and stay updated.